Welcome to The Explainer. Today, we're doing something really fun. We are taking a classic regional bank and putting it through the ultimate valuation test. We're going to analyze a single stock by applying the distinct frameworks of three absolute legends in investing: Warren Buffett, Peter Lynch, and Benjamin Graham, before running it through some modern quantitative models. Let's dive right into this ultimate valuation gauntlet. Here is our roadmap for today. We'll start with a quick company snapshot. Then, we'll test the stock against the Buffett lens, the Lynch lens, and the Graham lens. After that, we'll hit the DCF and quant models, and finally wrap it all up with our synthesis and verdict. All right, Section 1, Company Snapshot, TriCo Bank Shares. So, our subject today is TriCo Bank Shares, trading under the ticker TCBK. They are the holding company for Tri-Counties Bank. Think of them as a community-oriented, commercial lending-focused institution right out of Chico, California. They've got 77 offices across the state and are sitting on a very solid $9.9 billion in total assets. Oh, and for you income investors out there, they're currently offering a healthy 2.74% dividend yield, which, by the way, they have consistently bumped up for 12 straight years. Now, I want you to lock this exact number into your head, $52.64. That's the current trading price of TCBK stock. This is our baseline, okay? It's the number every single one of our investing gurus is going to judge against to tell us if this stock is a bargain, fairly priced, or dangerously overvalued. Moving right along to Section 2, the Buffett lens, looking at moats and owner earnings. You know Warren Buffett, right? He looks for understandable businesses, consistent earnings, and above all else, an economic moat. So we've got to ask the classic Buffett question here. Does TriCo actually have one? Well, as you might guess, in the regional banking sector, a true durable competitive advantage is notoriously tricky to pull off. When we dig into the numbers, we actually see some really solid financial returns. I mean, they're pulling a return on equity of nearly 10%, not to mention that 12-year dividend growth streak we just talked about. But we have to weigh that against the reality of localized competition. TriCo is a regional player, and they're going head-to-head with massive national banks that have literally billions of dollars in their tech budgets. Because of that heavy competition, it kind of lacks that wide, unassailable national moat that Buffett absolutely demands. But hey, Buffett also loves his owner earnings. Now for banks, calculating standard free cash flow is a bit of a headache, so we're explicitly assuming net income as our proxy here. TriCo pulled in a trailing 12-month net income of $121.6 million, and get this. They operate with a highly impressive 30% net profit margin that brilliantly illustrates their efficiency. So look, while the moat isn't miles wide, the underlying earnings engine is definitely humming. Still, without that massive protective moat, Buffett would almost certainly demand a pretty steep margin of safety before buying in. Section 3, the Lynch lens, growth and categorization. Okay, let's switch gears to Peter Lynch. First up, we need to categorize TCBK under his framework. Given that it's a mature company with a forecasted earnings growth rate of 5.79%, TriCo lands squarely in what Lynch calls the stalwart or slow grower category. It's your reliable, steady ship, definitely not a fast-growing rocket. Now, Lynch absolutely loves the PEG ratio. That's the price-to-earnings ratio divided by the growth rate. For him, the dream stock has a PEG of 1.0 or lower, and anything over 2.0, that's a giant red flag for overvaluation. So let's do the math. If we take TCBK's PEF 13.33 and divide it by that 5.79% growth forecast, we hit a PEG ratio of 2.3. Under Lynch's system, you're honestly just paying way too much for the growth you're getting. On top of that, Lynch loves finding those hidden gems, right? The ones with low institutional ownership and heavy insider buying. Unfortunately, TCBK doesn't exactly fit that profile either. Institutional ownership is sitting pretty high at over 59%, which means Wall Street is already well aware of this one. Meanwhile, insider ownership is under 5%, and there has been zero recent insider buying in the last 3 months. So for Lynch, this stock is a hard pass. Section 4, the Graham lens, defensive checklists. All right, time to bring in the father of value investing, Benjamin Graham, who is all about absolute downside protection. Now, what's really interesting here is how easily TCBK passes his ultra-conservative defensive investor checklist. Let's run through it quickly. Adequate size? Pass. They've got $9.9 billion in assets. Earning stability? Pass. $121.6 million in trailing net income. Dividend record? Easy pass. 12 straight years of payouts. Moderate price? Graham says the PE ratio times the price-to-book ratio must be less than 22.5. TCBK comes in around 17.19. That is a solid pass across the board. Since it breezed through that checklist, let's actually calculate what it's worth using the legendary Graham intrinsic value formula. We take his constant of 22.5, multiply that by the trailing earnings per share of 372, multiply that again by the tangible book value per share of roughly $40, and then just take the square root of that whole shebang. The results? A very conservative fair value of exactly $58.03. With the stock currently hovering around $52, Graham would actually see a real tangible margin of safety here. Section 5. DCF and Quant Models. Let's step away from the gurus for a second and break down the hard math of a base case discounted cash flow model. We're projecting out the cash flows using that mid-single-digit earnings growth rate of 5.79%. Then we apply a strict discount rate, or WACC, of 10% to account for risk, and assume a perpetual terminal growth rate of 2%. When you crunch those future cash flows all the way back to today's present value, these assumptions spit out a much higher fair value of $78.36 per share. According to the DCF model, this stock is heavily undervalued. Now, if we glance at comparable multiple models, it's a bit of a mixed bag. TCBK trades at a PE of 13.3. This tells us that while TCBK is slightly pricier than the immediate U.S. banks industry average of 11.7, it's actually an absolute steal compared to the broader peer average of 24.3. Plus, the dividend discount model, or DDM, acts as this fantastic secondary quantitative backstop. Because TriCo only pays out about 36% of its earnings as dividends, that 2.74% yield we talked about earlier is extremely safe. It has plenty of room to grow, and that provides a really strong mathematical floor for the stock's overall valuation. Finally, Section 6, Synthesis and Final Verdict. So let's bring it all together, because here is the crucial synthesis. We know the current price is $52.64. Graham and the DCF models see some immediate upside, valuing the company somewhere between $58 and $78, thanks to that strong book value and steady cash generation. But then you have Peter Lynch, who sees the stock as a hold or sell, purely because you're paying too much for that slow 5% growth. And Warren Buffett? Without a massive economic moat, he'd be demanding a much cheaper entry point, probably something closer to its $40 tangible book value. But look at this historical total return performance from 2020 to 2025. It brilliantly illustrates that steady, somewhat boring dividend-paying stalwarts like TriCo can still consistently compound and perform over time. The blended consensus across all these different frameworks, it's a solid hold. It's a high-quality, highly profitable bank, but at its current price, you're definitely going to need some patience for massive capital appreciation. And just like that, we've survived the gauntlet. The math is laid out on the table, but the investment philosophy, well, that's completely up to you. So I have a question to leave you with. Which investing guru's lens do you trust the most for valuing regional banks? Are you leaning toward Lynch's growth metrics, Graham's deep value formulas, or maybe that strict cash flow modeling? Think about it. Keep analyzing, keep asking questions, and I will see you in the next explainer.